Hey guys, it's Tortoise Investing coming at you today with 3 of the best stocks to buy now. These are all 3 down huge on the year, and I feel that they are all 3 great long-term compounders that fit into most portfolios. Now, if you're new, hit that subscribe button, drop a like for me down below. It makes the YouTube algorithm very happy, and I greatly appreciate it. And comment letting me know, do you own any of these stocks? Let's talk about it down below. Now, without further ado, none of this financial advice, always do your own research for investing. Let's go. Stock number 1 that we're going to be taking a look at is United Healthcare Group, coming in at $455.74. Now, they have seen a big drawback year to date. They were flirting around with the 550 area, now down 455, almost $100 off their high, down 15.5% year to date. Now, if you are a PE watcher, the PE ratio is below 20 with this one. I know the market is absolutely nuts right now. S&P itself is over 20. So, this might be a good value play. As I said, do your own research, look into things. Just free cash flow yield, 5.85%. So that's screaming, this is on a deal right now to me. Got a dividend yield of 1.53% and a payout ratio of 30.54%. So what that tells me is that dividend is in no trouble whatsoever, and you can expect some solid dividend growth from this company. Now take a look at the revenue over the last 10 years, growing at a rate of 11.81%. Take a look at the free cash flow, growing at a rate of 15.98%. That is absolutely wonderful. You want to see double-digit revenue and free cash flow growth, and that free cash flow has grown at a rate of almost 16% over the last 10 years, which is absolutely amazing. Earnings per share, 15.81% growth average over the last 10 years. Again, just right in line with free cash flow. Looks amazing. Debt's $54.4 billion. They have right at $30 billion in cash on hand. My general rule of thumb is I don't like companies that have more than 3 times their EBITDA in debt. This is nowhere near that. Whenever that is the situation, it kind of throws up a small red flag to me that, there might be something up their financial sheet that I might have to look into a little bit deeper. But again, that is not the case with this. Now, the dividend's been growing at a rate up 20.98% over the last 10 years. That's absolutely amazing. That is some compounding if I've ever seen it, with some slower growth as of late, but still right at a rate of 14%. Not going to complain about that whatsoever. And when it comes to share buybacks, they do little bits here and there. Nothing really to be screaming about over the last 1 year. 1.26%, so that's pretty significant. And the return on capital employed has pretty much been between 16 and 18 for forever and a day. Now, I did run this through my scenario through Qualtrim Insights to kind of get an estimate for an annual return possibility of the free cash flow. So to figure out future revenue growth, I just Googled it, and it brought me to simplywallstreet.com. Looks like the revenue is going to be growing at a rate of 7.1% on average for the next couple of years. So I tagged that in here. And the predictability of the free cash flow, as you've seen, that's just up and to the right. So I put that as high. And we can see here that, there's a strong chance of some double-digit growth when it comes to your annual returns with this holding. And I'm a big believer in them long term. I got in a little bit soon, and then it went down some more, so I'm just going to look at that as a buying opportunity to just load up on more shares. Next up, we got StarBucks Corporation. One of the most addicting things in the world is caffeine, and Starbucks is everywhere, and I just feel like their stores are always just jam-packed. Now, they were over 100 recently, I'm wanting to say. Yeah, about a year ago. Last May, they were right at 115, down to right at $87 a share now. So the dividend yield is 2.63%. The payout ratio is 58.82%. And the adjusted free cash flow yield is just over 4%. So again, shows me that it might be at a pretty good value right now. Always doing research. Revenue's been growing at a rate of 9.22% over the last 10 years. The free cash flow has been growing at a rate of 7.66% over the last 10 years. So not quite double digit, but I still like what they're doing. I still think that they have an amazing future ahead of them. The EPS has been growing rapidly. This is going to be thrown off a little bit, but very nice double-digit growth, more than likely, out of their EPS going forward. And as you see here, the projected earnings growing, their EPS is at 11.2%. So I think that that's something that they're going to be able to just keep trucking right along with. Debt, they have 12.27 billion. Their EBITDA is 7.33 billion. No issues there. They have almost 4 billion cash on hand. The dividend's been increased at a rate of 15.93% over the last 10 years, but here recently they have been a little bit slower, looking at anywhere from 7 to 8%. Still inflation beating growth from your dividend, which is what you always want to see. Share buybacks, it looks like they do some here and there. Slowly but surely, I mean, from 2020 to 2023, it looks like they have chipped at it from 1.18 billion to 1.15 billion. So they are doing some share buybacks. And another place that this company shines is the return on capital employed just continues to grow. If you look here, 2021 is at 20.96%, 2022 is 24.53%, and 2023 is at 29.21%. So that ROC is increasing year over year. Now I tagged this into the scenarios tab as well. I put medium on their projected growth because it is going up, but it's a little erratic-ish. So whenever you put that in, again, they're at a 6% yield right now. Not 6%. They're at a 4% yield right now. So things are looking great for a strong chance of double-digit annual returns from this one. Again, none of this is guaranteed. This is just a little projection model that is included with Qualtrim Insights. Now, lastly, the last stock we're going to be taking a look at is a REIT. REITs are treated differently, so make sure to do your research into those before investing into REITs. REITs are real estate investment trusts, and this is Agree Realty Income. This one and just Realty Income in general, which is the monthly dividend paying. I feel those are two of your top monthly paying REITs. I just like this one a little bit more. Dividend yields at 5.29%, and as you see here, they are down year to date almost 12%. You take a look at the 1 year chart, they are hovering around that 52-week low. So revenue's been growing at a rate of just bonkers to right at 30% over the last 10 years. The revenue is just taking off like a rocket. Same situation with the free cash flow, which is what you always want to see. Whenever REITs do pay out their dividend, they pay it from funds from operations, their FFO, so it's another thing, if you're not familiar with it, to check in and do a little research on. So take a look at the dividend, and REITs always carry a lot of debt, so this is, it's important, but not really. Dividend's been increased at a rate of 4% over the last 2 years annually. If you take a look here, it looks a little bit off. They went from paying quarterly to paying monthly. I think it was a good idea. I think people like to see those monthly dividends roll into their portfolio. If you take a look at the revenue is expected to be kind of flat-ish over the next year or two. And a thing that can be attributed to that, REITs are very debt heavy, and with interest rates being the way they are, and it looks like interest rates are going to be even higher for even longer, it might be the time to gobble up some REITs at some discounted prices. Again, not financial advice. Do your own research before investing into anything. That's everything I got for you today. I hope you enjoyed that. Make sure to hit the like and subscribe button for more. Until next time, take care. See yous.